I'm Owen Bigland. This is the Inside Edge video blog. Okay, we're now into early March 2022. I'm never sure. Sometimes I'll shoot a few of these videos in reserve if I get real busy and post them, sometimes 2-3 weeks later. It depends. But as I speak right now, you know, the stock markets, especially the S&P 500, the Dow, the NASDAQ, the TSX hasn't been hit nearly as bad. But we've had about a 12% sell-off. It was much higher before. It was closer to about 15 to 16%. And then, of course, I own some stocks, some of my tech stuff that's off, you know, well over 20-25%, like Meta. So we've had a pretty good sell-off here. It's a combination of a number of things. You know, the Fed starting to signal that they're going to be raising interest rates. They still haven't yet. They're going to be in a couple of weeks, depending on when I post this. But then, of course, the issue with Russia invading Ukraine. So lots of stuff going on. These type of sell-offs of 10-15% are very normal. How many times have I told you guys about these? You should expect a 10% pullback 2 or 3 times every year in the markets. Something of 15 to 20% every couple of years, and something 30-35% every 5 or 6 years, like clockwork. Use these dips, these sell-offs as good buying windows if you can. Keep some dry powder. I'm fortunate enough, I've got a big enough portfolio that I've got dry powder coming in every week. I'm contributing to my portfolio through my working income. And then, of course, I'm getting dividend deposits on a weekly basis from my holdings, some of them several $1,000s every quarter. So I'm able to put money to work. I can tell you, I'm pretty much always 100% invested. I've been buying a lot the last couple of weeks. If you follow me on Twitter, I've been topping up in a lot of my holdings, everything from Estee Lauder, Morgan Stanley, JP Morgan, buying the Triple Q, buying the VIG. So if you follow me on Twitter, I've done more that I've been buying. The problem I've got now, I wish I had a little more dry powder this past week, because there are some good buying windows, opportunities out there. I'm quite confident that some of these companies I'm buying today at these prices in 5 or 10 years are going to look incredibly cheap. But, you know, so use these opportunities. You know, I had a really nice phone call with one of my Wall Street guys in New York. I've mentioned him in passing here a few times. Very smart guy. He's been on Wall Street for over 20 years. He's a private equity guy. You know, very similar philosophies to I have. You know, buy the best, buy quality, and hang on to it. And, you know, if you read my book, I talk about, you know, in chapter 7 here, how the stock market really works and building your portfolio the proper way. And the conversation I had with my friend, I always enjoy talking with him. Every couple of months, we'll have a phone call. I try and get out to New York once or twice a year. I haven't been lately with COVID. I'm hoping to get out there later this spring. But I always hang up with a you know, just always learn a little bit more from him. And it's just positive affirmation to stay the course. You know, a few of the things that we talked about, you know, these geopolitical situations, like what's going on in the Ukraine right now, you know, at the time they always look like a risk. And that's why you have had a lot of people selling off companies. And they throw the baby out with the bathwater. Many of these companies had nothing to do with what was going on in Ukraine. It would affect their business pretty much zero. But of course, that's not how the way the stock market works. You just get indiscriminate selling. People just dump everything, risk on, risk off. So they can be incredible buying opportunities. And in hindsight, I can tell you that every one of these type of situations at the time seems like a risk. But when you look back on them 4 or 5 years from now, they will look like incredible buying opportunities. And I've been through enough of these over the last over 25 years as an investor to know that. So I'm usually buying with both fists. Whatever I can buy and whatever cash available I have, I'm topping up on these fantastic companies. Or I'm just buying the broad index. Some of these sell-offs we had of 600-700 points, I don't just wait. I just buy the whole index. Just buy the S&P 500 or the Dow or the Triple Q. But, you know, as I talk about in chapter 7, how the stock market really works, a lot of people, and I get this in the comment section on my blog here, they seem to think that the individual investor, a guy like me, or what we call a mom and pop investor, a retail investor, that somehow we're at a disadvantage, that the big guys, the private equity guys and the big time money managers and portfolio managers that are running these funds have a huge advantage over us. And I'm telling you, they don't. As a matter of fact, you have a huge advantage over them. If you want to trade stock and speculate on stock, then yes, you have a huge disadvantage. You will lose your money that way. You might have a couple of good years, but eventually they will wear you down. You are not going to beat these guys if you're going to play the trading game. Buying this, selling that, buying this, selling that. That is a loser's game. But if you become a buy and hold of quality companies, or just buying and holding the indexes, you are going to do incredible, and you have a huge advantage over these professional money managers for a number of reasons. As I point out in my book, these professional money managers are under the gun to perform. And by that I mean that they're under the gun because they charge these outlandish fees to their clients or their institutional investors that are investing with them, under the premise that we will beat the index, we will outperform the index. But as people know and have realized now, is that 9 out of every 10 of these professional money managers can't beat the index every year. They can't beat the S&P or the Triple Q or whatever index you're following. 9 out of 10. And the 1 out of every 10 that does just barely beats it after you back out the fees. And the other thing is they can't do it consistently. Warren Buffett talks about this all the time. Warren Buffett had that bet going with that hedge fund guy that they did about 11 years ago, where the hedge fund guy said that he could beat an index consistently over 10 years. Warren Buffett bet him $1 million. Warren Buffett put his money in the S&P 500, the Vanguard, VOO, and just left it there. This guy traded in and out of stocks for the next 10 years. And at the end of the 10 years, Warren Buffett blew him out of the water. The index beat him. It's like a carrot chasing a stick on a carrot on a stick. So for that reason, just buy and hold either quality names like a Johnson & Johnson or an Apple or an Amazon or a Procter & Gamble or a Pepsi or a McCormick or an Estee Lauder and keep them. Good companies tend to keep winning. Yeah, they'll fall on some harder times, miss a few quarters of earnings, but unless something drastically changed with the fundamentals of the business, they tend to recover and keep winning. Or just, as I've often said, just buy the index. For 99% of you, that's all you need to do. But these money managers are under the gun to try and outperform it, and they can't. That's how they get away with charging their outlandish fees and commissions. The other thing, of course, is these money managers, and my friend in New York was the first one that introduced me to this. They'll never tell you this in public because, of course, they want to keep that myth going that I'm a professional money manager, pay me 1% or 2% under management, and I will navigate these rocky markets and these tumultuous markets, get you in and out of positions, and I will, get you superior returns. It's a lie. They can't. If you put a few drinks in these guys, they would admit to you that they can't do it. Most of them are falling woefully behind the S&P 500 every year. That's why most of them never post the results. Why do you think these guys that come on BNN picking stock, why do you think they don't post what their fund has done the last 1 year, 2 year, or 5 year compared to the TSX or the S&P 500? They don't want to. They don't because they're lagging it. And they're trying to charge you 2% for the privilege. But the other thing these professional money managers have against them is that they've got thousands and thousands of investors of various sizes. When something like the Ukraine situation happens, some of these guys panic. They're weak hands. They don't understand how the markets work in these situations and how these things are usually transient and short-lived and why they should be buying, not selling. But they don't care. They're not thinking logically. They call the money manager up and say, I want out. Redeem, sell my portfolio, put me in cash. The money manager might try and talk him out of it, telling him this is the worst time to do that, but they don't care. They have to sell the stock. So this money manager now has to redeem, he has to sell shares, and he has to plug his nose and sell a bunch of stuff that he doesn't really want to so that he can raise the cash to pay this guy out. And that happens endlessly over and over. It's just a vicious circle. The money manager doesn't want to sell anything. But what do I have to sell? Well, I'll sell my winners. I'll sell my Apple, or my Johnson & Johnson, or my McCormick, or my Costco, or my Home Depot. I don't want to, but I need to raise $100 million for this investor who wants out. which greatly diminishes their long-term returns. So that's kind of the dirty secret of the stock market that a lot of people don't realize. I've had guys on my blog here saying that, the stock market is rigged, the little guy doesn't have a hope. A lot of these guys, they always point to that book by Michael Lewis called Flash Boys, which came out about 3 or 4 years ago. A nice little summertime read, but it didn't mean anything. Just not to bore you guys with the details, but it's about something called front running, where these large institutional traders that are trading hundreds of millions of dollars every day are able to get in front of your trade and shave a quarter cent off every share, or off every share price. It's ridiculous. First off, you can eliminate front running altogether if you put in a limit order instead of a market order. The other thing is, I've often found I use market orders because I usually get a better price when I use a market order. But even still, if you're buying 50 shares of TD Bank and they front run you a quarter cent, wow, you just paid 50 cents more than you should have on a $4,000 trade. It's irrelevant. But learn the basics of how the stock market works. My book would be a good start, but the individual mom and pop investor, the buy and hold investor who's buying quality, keeping it, collecting the dividends and reinvesting it, you have a huge advantage over these big Wall Street guys. Now, I do look at what my portfolio does compared to the indexes. First off, half my portfolio is in the indexes. The other half of my portfolio is in hand-selected, the best of the best, the Macdonalds, the Home Depots, the Apples, the Googles, the Amazons. Last year, I did beat the index. It was a fluke, but I did beat it, not by much. Last year I didn't. The year before that, I also beat the index with my portfolio. It was a fluke again. So I'm able sometimes to edge it out myself, but that's not what I'm trying to accomplish. I'm more than happy to receive the overall returns of the general market, which, remember, over time, over 10, 15, 20 years, will do very well for you. You're probably going to average about a 6-7% return. Not every year. There'll be good years and bad years. Plus, you might get another 3% dividend on top of that. Remember, if you can get a 6, 7, 8% return annually, I'm more than happy with that. That'll double my money every 7 or 8 years, and you're going to do incredible with that when you add in the compounding, earning dollars on top of dollars. So, in times like this, stay the course. Use these sell-offs as incredible buying windows to buy the right companies. And when I say buy the right companies, I'm not talking about buying some electric vehicle startup or some meme stock. Buy the high-quality names with, strong cash flows, strong balance sheets. Pay a nice dividend, or perhaps, or especially have a growing dividend with a low payout ratio. Or just, again, for the first couple 100,000 for most of you guys, just buy the index. Buy the S&P 500, buy the TSX, buy the VIG, reinvest the dividends, and then call it a day. You don't need to be sitting in front of a computer terminal looking at stock prices go up and down. I spend very little time on my portfolio. Once I get a little dry powder in place, I've always got a short list of stocks that I have on my watch list. I get 5 or 6K together, and boom, I'll pull the trigger with a market order and add it to my portfolio. And I always look at it, if it pays a dividend, if you buy $10,000 worth of Morgan Stanley, it's yielding 3%. That's $300 in dividends this year that they're going to pay. I look at that as buying myself 1 day of financial freedom. You continue that for 365 more trades, and you've now bought yourself financial freedom for life. Remember, those dividends are going to be paid for the most part through thick and thin. Whether the market's up or down, they have very little effect on your on your dividend payments. So stay the course. Use these sell-offs as good buying windows. The buy and hold, the individual investor has a huge advantage I don't think a lot of people realize. I'm Owen Bigland. As always, have a good weekend. See you next week.